Welcome back to Trendlines over Headlines, the show where we break down the markets with some of the best traders and analysts in the world. My name's Patrick Dunawilla. I'm the editor of the Chart Report, and I'll be your host. We've got a special guest returning to the show today. Brian Shannon is going to be joining us to talk about his new book, Maximum Trading Gains with Anchored VWAP. It just hit the shelves a couple weeks ago, and it's already the #1 bestseller in its category on Amazon. He's got over 30 years of market experience under his belt, and he's probably the most disciplined discretionary trader I've ever met. So it's going to be a great conversation, but before we talk to Brian, it's Friday, the markets are closed, so let's take a quick look at how this week played out. All right, so all four major indices closed lower this week. The Dow led, but it was pretty much unchanged for the second week in a row. Now, we covered this in our chart of the day today, but we're coiling into this tight range, so energy is building for a strong move in either direction on the Dow. The Russell 2000 was the laggard this week, dropping more than 3%. Now, taking a quick look at the S&P 500, it slipped a little over 1% this week. We closed below that crucial 4,100 level that everyone's watching, so kind of looking like a failed breakout, and that's going to be an important one to watch next week. As far as the sectors go, this week was 2022 all over again. Energy was the only sector that closed higher, and it led by a pretty wide margin, gaining nearly 5%. On the flip side, communications lagged by a wide margin, dropping more than 5.5%. Anyways, that's enough from me. Let's welcome Brian onto the show. All right, Brian, welcome back to the show, and a big congratulations on the new book.
Thanks so much, Patrick. It's good to have it out there in getting in people's hands.
Yeah, I mean, that must be awesome. It's #1 in its category. I think it's in top 500 of all books sold on Amazon. That's pretty
Yeah,
big deal.
it got as high as 266, I'm proud to say.
Yeah, and I got my copy right here. You were gracious enough to give me a signed copy, so I appreciate that very much.
You're welcome.
And I got to tell you, I read it cover to cover this past week, and it's fantastic. I really think it's probably going to become a classic and a must read if you are into technical analysis. And what I really like about it is there's a ton for both beginners and professionals in there. And I also like, by the way, that it's in color. I mean, how many technical analysis textbooks have we had to read that are, black and white like that, right?
But that's part of why I self-publish it, to have control of that, to have control of the title, to have control of the money, of everything. I mean, traditional publishing, there's a market for that, but if you're willing to put in the work, self-publishing is a great way to go. And I've hired an awesome team to make it look just as good. I think better than your average book off the trading book off the shelf. Like you said, it's got 150 color charts in there, and it's I appreciate the kind words. I hope it is a classic.
Yeah, another few things I liked. I really liked that you touched on, market psychology and some of the behavioral biases that we all run into. And you did a good job kind of incorporating that into the AVWAP. And also, I love the quotes. I'm a sucker for quotes, and the thing's packed with quotes. So I really like that too.
Yep.
Anyways, I know we introduced the VWAP the last time you were on the show, but for our new viewers, if you could just give us a quick refresh on
Right.
what the VWAP is to you.
Well, the VWAP itself, the volume weighted average price, is for 1 day. It's the combination of price, volume, and time. It gives you the cumulative average price the stock traded at from the beginning of the day. That's the traditional VWAP. The anchored VWAP is just that you start the measurement at any point other than the beginning of 1 day. You could start it at, let's say the stock made an 11:30 high at 11:30 a.m. Eastern. You could anchor one there. You can also use it on daily charts, weekly charts, monthly charts. I use it a lot on a 15-minute time frame. So it gives you the volume weighted average price from any point. So what you want to look at it as is the absolute supply and demand truth from any beginning point. So whether it's the beginning of the day, from an earnings report, from a Fed report, whatever it might be, if you're measuring from that point forward, it tells you with 100% certainty who's in control, the buyers or sellers, and if it's starting to lose control. So it's just objective truth in the market, which we don't have a lot of.
Yeah, and I liked how you made that distinction very clear in the book between VWAP and anchored VWAP.
But
And I always kind of think of you as the person who discovered a VWAP, but you mentioned that you kind of adapted it from somebody else, right?
sure, Paul Levine is his name. He was a PhD, like mathematical genius, and he kind of founded it in 1992. The VWAP itself was originated in 1988. So 4 years later, this guy was developing anchored VWAP strategies, and sadly, he died. Maybe about 4 years after that. I should look into his biography a little bit more. There was another anchored volume weighted average price book that is, it's a little bit dense, I think. So I wanted to make something that gives actual specific strategies, the background, and I've become the adopted father of the volume weighted average price and anchored VWAP. It's largely due to a lot of my initiatives that it's on a lot of the various trading platforms that you can find it on today.
Yeah, I mean, as far as I'm concerned, you are the person who really popularized it. But it started off as an institutional benchmark for order execution. Is that right?
Correct. Yes. It allowed them to say, how well did our order get executed? So that's where it originated in 1988. So that an institution who, maybe sent an order to buy 500,000 shares to Goldman Sachs, at the end of the day, they want to know, did we receive a fair price? They had no other way of knowing. They just look at the range for the day and where it closed and say, well, that's the price they gave us. And obviously, there's a lot of room for the trading broker to pad his profits without an accurate number of what was the they call it the price, a reason that you could reasonably expect an average trader to get that day. So it's just the average, but they don't want better. I mean, they would like better, of course, but they just don't want to get screwed over, basically. And this gave them the opportunity to say, hey, what's going on here? We're not getting truth in our pricing, and we're going to go do our business somewhere else.
Yeah, and one of my favorite chapters from the book, I believe it was chapter 3 in part 1. You
Mm-hmm.
divided the book up into 3 parts, but really 2 main parts. The third is kind of just an appendix and resources index,
Jump.
stuff like that. But the first part is really the foundations, and then the second part is strategies and how applications, right? How you actually use the VWAP. But in that first part, one of my favorite chapters, chapter 3, was talking about how institutions use VWAP, not just as an institutional benchmark,
Right.
but to execute large orders, whether that's buy or sell orders. And here you have this great quote from Ken Griffin, who is, of course, one of the richest men in America and one of the largest market makers, or heads the firm that is the largest market maker, which is Citadel.
Right.
And this quote's awesome. He says, and this was from a congressional testimony: today, virtually all trades are executed by institutional investors. By institutional investors are in the form of program trades such as VWAP or other algorithm trades. VWAP trades are not large trades. It's not like there's 10 million shares to be bought. It's a trade that's sliced into smaller orders and executed over the course of a day, a week, or a month. And that last part, executed over a day, a week, or a month, that's a pretty important part, right?
It is. I think I bolded it or italicized it in the book and said I intentionally did that to emphasize the point that I still see people today saying, well, because they don't haven't had the education about the volume weighted average price and anchored VWAP, that they're confused and think it's just for day traders when that's just not the truth. When you look at, Ken Griffin was just named the most profitable hedge fund trader ever, most profitable hedge fund. This was just this year. And here we see 2 years ago, he was kind of giving away a little bit of his secret sauce when he spoke in front of Congress by saying, we use this to execute orders over the course of a day, a week, a month, or in many cases, you'll see several months. So it's the ability to take a large order and absorb it into the market without being noticed is the main thing, without having market impact cost. If you or I go in and buy 5,000 shares of a stock, it's not going to do anything if it's a liquid stock. They're going in to try to buy 5, 10, 50 million shares over the course of a couple months. It's not easy to do that. And in fact, you always hear people say, the institutions leave their footprints, and their footprints are that volume and just the persistent buying. They have to spread their order out over 90 days because it's so massive, to get it done.
Yeah, and you use this great example of why an institution would have to do that, right? And again, you talk about, parent and child orders, right?
Right.
And so the example you used in the book was a mutual fund owns 3% of stock XYZ. And let's say that's 15 million shares, right? And they want to sell half of it. So they want to sell 7.5 million shares. And the stock XYZ only trades about 2 million shares a day, right? So if they sell that whole order, that's going to have what you called market impact, right? Could you explain that a little more?
That's just what it's known in the business is what is the outcome of my order being executed in the market? What's the net effect on the stock? If the stock trades 2 million shares a day on average, you're trying to sell 7.5 million shares, you're going to knock that stock down 50%. So obviously that would just be stupid. So the way that they want to do it, that's the parent order. So they break it into child orders. So, that's just, it's the family of orders. So they might look at it and say, well, the average daily volume is 2 million shares. So we don't want to do more than 5% of the average daily volume. That means we're going to do 100,000 shares each day over the next, what did I say, 7.5 million shares, 75 days. So what they'll then do is look at that volume profile for the day. It's that U shape that we always see where we've got the heavy volume at the beginning of the day. It starts to trail off a little bit. Midday, it slows down. Later in the day, the volume ramps up again. And you see that U-shaped come into the volume pattern.
Yeah,
So
volume's kind of bookended there. You have the high volume at the open, high volume at the close, and kind of a lull in the middle of the day.
great way to describe it. Yeah. So when the orders, from these institutions to sell that 100,000 shares today, to sell that 100,000 shares tomorrow, etc., they will look at that volume profile and they'll say, okay, in the first minute of the day, it typically trades 2% of the average daily volume. I'm making this up, of course. But that means if they have 100,000 shares, well, what they're going to do is they're going to look to sell 2,000 shares so that they don't impact the market. They're absorbing in with the average daily volume, just kind of filtering in, and they don't want to impact it. So they do 2,000 shares of their sell, theoretically in that first minute. The next minute, maybe it does 1,000 of its average daily volume. So they sell another 1,000 shares. Midday, maybe they've got about 63,000 shares left. And then they'll start to kind of readjust their algorithm for where it is based on the volume weighted average price for that day. I mean, it gets super complicated. These algorithms are crazy detail, and we don't need to get into the nitty gritty of them. But what happens, Patrick, is you'll see that as the stock, let's say they're selling the stock, and the stock got knocked down in the morning, it rallies back up later in the day. Well, they want to get as good as or better than the volume weighted average price for the day. So they might let it trickle through that volume weighted average price for the day and see if they can find a buyer for 10,000 shares because they know they have 60,000 shares left. So they'll be a seller at that fair value volume weighted average price for the day. And that self reinforces that U shape that we see happen because it's just trying to sneak along, not going noticed, just kind of, follow, sneak in, absorb in the crowd and not stand out. You're just trying to not stand out in the crowd and get that order done. But when they have the opportunity that the stock ramps up, intraday real quick because the Fed said something, it gets through the VWAP, then they're going to go, bang, let's sell 30,000 shares of this thing because it's weak. And, again, I don't want to get too into the weeds on it. It gets pretty complicated, but that's, the basis of how they'll get that 100,000 shares done that day. The next
Yeah,
day, kind of repeats the same process until they've read the order.
yeah, and I really like that concept of parent and child order. It's something I haven't really heard ever put into words the way you did it in the book. But it makes sense. For anyone who's ever looked at time and sales data, you'll notice that a lot of the times it's just these 100 share blocks or smaller orders right after each other. And it's not just somebody placing 100 shares here and there. Like you said, it's probably a larger order broken down into pieces and executed throughout the day. But we covered a hypothetical example, stock XYZ, but you brought up this great example of Warren Buffett and how he had to get out of a position in Southwest Airlines. I think it was back in 2020. He had to sell what, 2.3 million shares.
Yeah.
So break down this example for us.
One, Warren Buffett panicked. Okay, let's make that clear. Warren Buffett panicked because of COVID, decided to throw his airline stocks away. Whether
That's a
that was
good point.
or not, I don't know. But the fact is, he was motivated by news, just like every single person on the planet is sometimes.
Yeah, I mean, this was April 2020. I mean, the world was shut down. You remember that? We were all in our homes.
And of course I do. And airline stocks looked like they were probably going to go out of business. So he
Right.
looked at it and said, "This is where we expect it to be in 6 months. I don't want to own this thing anymore because this could go on for who knows how long." Anyways, there's of course dark pool exchanges where negotiated prints occur, and that wouldn't be part of that parent-child order. A lot of times a big piece of the order might actually get executed off exchange. Let's say 50,000 shares they find on a dark pool at a negotiated price, and the rest of the 50,000 would get executed. But there's also what's known as a volume weighted average price guaranteed order. So there's a lot of brokerages, that will transact agency business that will say, we'll sell your stock or we'll buy your stock. Tell us exactly what the order is. Don't play games with us, but tell us exactly what the order is, and we will guarantee you the VWAP during the course of the time it takes to execute that order. So Warren
How
Buffett.
can they do that? How can they guarantee a VWAP like that?
Well, because most of the time their programs are good enough that they realize, sometimes they're going to lose some money. I think in the case of Southwest, this order, they most likely lost some money on the trade, but they'll go make it up, later down the road. But the
I
point
see.
was that, when that order was filled in the news, it said, Warren Buffett sold 2.3 million shares at an average price of 32.20, whatever it was. So I looked at it and I looked at the chart. I pulled it up and I put a 2-day volume weighted average price on there. And I said that was no one said it, but it was clearly a guaranteed VWAP order because that was the exact volume weighted average price anchored to the prior day. So it was an anchored volume weighted average price because it was for 2 days during the time it took to execute that sell block.
Yeah, I mean, you mentioned it before, you're kind of seeing footprints of institutions, and this is clearly Warren Buffett's footprints on that 2-day chart there. But
Right. And so what you'll notice too on that chart is, when it pops up through the volume weighted average price, I should have actually included the volume below because it spiked dramatically. And that was most likely that program saying, hey, we got to sell as much as we can up here because we're behind on this order and we need to get some more off at a higher price. Otherwise, this is going to hurt our trading desk this month and therefore our bonuses.
I like that. So, another important thing in regards to VWAP and something I've always wondered about that you covered extensively in the book is where to set your anchor point, where to anchor the VWAP to. And you mentioned in there that's one of the most subjective parts of the analysis, the anchor point.
Right.
And it's subjective, and you didn't shy away from the fact that this is kind of where the art meets the science.
Yep.
And as subjective as it is, you laid out some pretty clear guidelines on where to set that anchor. So I just want to go over a few of them real quick. And I know we're really just scratching the surface here. For our viewers, if you're interested in some of these concepts and strategies and want to delve further, definitely go pick up the book because it's all in there. Again, we're just scratching the surface, and you go into depth on a lot of these things that we're about to talk about. You address them in whole chapters later on in the book. So, you mentioned in there, you want to anchor to a point or an event which causes a big shift in market psychology. So, what are some of those events that you're talking about?
Yeah, so something that causes a supply and demand shock, really, Patrick. I mean, and that shock comes in the form often of big volume, which affects the psychology of the participants. A sudden rapid reevaluation of what is this stock worth. So you think about what causes that to happen. Well, certainly earnings reports. At the end of the day, all stocks trade based on earnings at some point based on future expectations. When the Federal Reserve announces any change to monetary policy, I immediately anchor a volume weighted average price on that first minute. I won't trade it on that first minute because we get that back and forth, but it starts to show that it becomes support or resistance almost to the penny in the next few days after that. For the earnings reports, a volume weighted average price anchored to that day can often be important for 3 or 4 quarters even. If you get a big breakout from a base, let's say, it'll often act as support on pullbacks. The jobs report, any press release that causes again a shift in the supply and demand dynamics that causes a rapid reevaluation of the price of the stock. What's not on there? So, like you said, on their biotech, like a news story, or some even a buyback. But what I also love to anchor to is new highs and lows, swing highs and lows. It tells me who has control from that most recent high. Where do the buyers regain control if it gets back above it? It tells me with 100% certainty where the buyers have fully gained control based on the cumulative average price weighted by volume from that point.
Yeah, I mean, there's a lot of price memory there at those points. There's a lot of talk about the 200-day moving average and the downtrend line from the peak.
Yeah.
And those acted as resistance pretty much all last year, but the anchored VWAP from the peak on something like the NASDAQ or the S&P 500, that came into play so many times, at least 3 or 4 times over the past year as well, right?
Yeah, and that's the important thing is it's a tool. It's just like a moving average. It's just like Fibonacci. It's just like stochastic. It's something that we use to gain an edge in the market. The difference between a simple moving average or even an exponential moving average is that the moving averages are based on time. What is the average price, time and price? It doesn't consider volume. So what we're doing is saying 200 days. Well, why is 200 days? Why is 50 days important? And they are important, but the reason is because the participants have agreed that they're important. There's no
Right. Other than that, they're kind of arbitrary, right?
right? Is there magic to Fibonacci? Some people will say there is. Or is it just that there's a shift in supply and demand there because it lines up on people's charts and they decide not to take action to buy? Other people take action to short. Other people take action to reduce their exposure. So it's all about what happens at those levels of interest. They're not always an action point, but they often become the precise level where a market does turn in moving averages or in the anchored VWAPs. But the anchored VWAPs are more objective in terms of supply and demand from a low, from a gap, from a Federal Reserve or the recent high or whatever it might be. It's the absolute truth from that point.
Yeah, and one other thing you talked about was anchoring to a specific time. And again, that's more of just the VWAP, not an anchored VWAP. You have the intraday VWAP, week to date, month to date, quarter to date, and year to date. And those do come into play all the time. But I want to talk about some of the strategies. And you have this one I really like, VWAP handoff it's kind of one VWAP passing the baton or passing the torch to the
Right.
next one, right? Could you
Yeah.
explain that a little bit?
Sure. So, and just to be clear, the when it comes to VWAP, it's really from the beginning of the day. Other time-based ones, they're anchored to the beginning of the week. They're anchored to the beginning of the year. So just going back to clarify that point. But the handoff, what we see is, we'll get a move off of a low. The stock will run up, come back and test it, and then bounce, and then it'll bounce, maybe turn sideways again, then have a powerful move. So there's a new regime, there's a new shift in the aggressiveness of the buyers or sellers. And once it breaks and really starts to have a more dramatic move from there, we take the point where the stock last touched the prior important volume weighted average price and we anchor a new one to that. So it says now, if we were in from before, well, now the momentum has brought in a new group of hungrier participants, hungrier buyers. So we want to measure based on what they're doing, not the old trend, because now if we follow the old trend, it's so much slower to move because there's so much data in the denominator versus the faster anchored VWAP that's just been 2 weeks old, 3 weeks old. So it allows us to maybe look at and say, I want to look for pullbacks to this anchored VWAP and buy the strength as it rallies away. Or if you already have your position, it's a great way to say, as long as the buyers are in control from this point, I'm going to raise my stop up under the successive higher lows. And, based on the shorter anchored VWAP rather than from the one that's still lagging from 6 months ago.
Right. The handoff can kind of act like a trade management tool, a risk management tool once you're in the trade, right? You know,
Yeah.
a lot of
Yeah.
people will
So
raise their stops up. This kind of offers you a clear level to do so, right?
yeah, and it's like a bringing in a fresh new runner to a relay team, right? That fresh runner, the anchor, runner at the end of the race is typically the fastest one. So you want to look at them and go, okay, well, the average person is doing 60 seconds around the track. This person can do it in 47. We want to anchor to that because that's the new momentum. That's the new shift. And that's what we want to place our bets on. It's not the old average because this new average can go chase down that other runner and bring this thing home and win it.
Yeah, and you talked about slope of the VWAP a lot and kind of how you think about that too. And we won't get into that because I'll let our viewers get the book and dive into that themselves. But the other strategy I wanted to touch on real quick was the VWAP pinch. Could you
Yep.
explain that one?
Yeah, so the pinch basically just takes two starting points. In what we'll see is, for this one that you have, we have a downtrend, and the downtrend comes down, and stock kind of gets tired of going down, so it starts turning sideways. There might have been a big shakeout, and then the stocks rallies strongly from there. Well, we only know that it was a shakeout low, maybe 5 days after the fact. So we anchor a VWAP to that low. What we'll often see is it rallies off of there. So short term, the buyers are taking control, but intermediate term, there's still a downtrend. So it rallies up to that intermediate term declining anchored VWAP. The bottom one comes up and kind of then the stock compresses between the two of them and builds energy. And when it breaks from there, it confirms that the two time anchored VWAPs are now in alignment, similar to my first book, which is about trend alignment based on time. This is trend alignment based on the actual supply and demand again. And when they come together and we have a break out of that range, that allows for that compression of energy that was built up to release, and a new trend reemerges, and that's often a great place to do a handoff from as well when it breaks back out of that pitch.
Yeah, I mean, the pattern kind of goes along with like a coil pattern in classical charting, where you have out of range contraction comes range expansion. It's kind of a similar idea there, right?
Like a spring, it just gets compressed in there and until it just the steam pot is just ready to go and it's plugged up and it just explodes at some point. So that's the same thing. Energy gets compressed, one side takes control, it takes the other side off guard, so they scramble to get rid of their longs. The shorts say, we're not going to let this thing rally. We're going to continue to put offers, and we're going to scare these dummies out of it who bought it in that little range. And we're going to cause fear and pandemonium, and hopefully, we'll get the stock to decline rapidly so we can cover lower prices. Or it backfires and it runs back up through them, which is why we have to stop.
Right, right. And that brings me to my next one. On one of the chapters, this one really caught my eye. It was kind of your key trading principles. And, I think you were probably channeling your inner Marty Zweig on this one because you actually started the chapter off with a Marty Zweig quote.
Oh, did I?
But yeah, but I say that because, Marty Zweig, he had his, whatever it was, 12 rules.
Uh-huh.
Bob Farrell had his 10 rules. And
Yeah.
this kind of reminded me of that. And I know you pretty well. And these I do think kind of exemplify your outlook on the market and your style of trading. And that first one, risk management is job number one, limit losses. I think you probably said risk management is job number one, probably at least 3 times in the book, but it's such an important part, right?
Yeah, I mean, I hope I said it more than that. I know I did a document search on my old book. I think I said it 12 times. And I emphasize risk throughout. In fact, every single chapter, you note that there is a risk management, a paragraph to 3 paragraphs long about that particular strategy and how to deal with things when they go the wrong way. So, I mean, it's what's kept me in the game, Patrick, since 1991 is just a brutal, ruthless execution of risk management. And the more experienced I get, the more ruthless I get in that because big losses are just too difficult to come back from.
Yeah, absolutely. And my personal favorite was number 7 there, create your own process. I think that's so important. We all have mentors and it can be really easy to just do whatever they say or take all the trades that they're taking. At the end of the day, people's investment process is more unique to them than their thumbprint. So you really have to find what works for you, what works with your risk tolerance, all that. And you use that great example of Jimi Hendrix at Woodstock playing the Star Spangled Banner.
Yeah.
And of course, Francis Scott Key wrote that song, but Jimi Hendrix made it completely his own, right?
Yeah, he would be rolling in his grave if he heard it. I'm sure going, "What is that racket? What have they done with my song?" But it's an important thing, and you picked up 2 really good ones, Patrick, because anytime I mention a stock on Twitter, I mention 2 things generally, almost 100% of the time. This is where a worst case stop would go for me. I'm an aggressive swing trader, and then I say make the trade your own, and by that I mean, if you're a day trader, go ahead and go day trade this stock. Don't use that stop; it's too loose. If you're an investor and you see that this is a good entry point for a longer term hold, well, adjust the stop to your time frame. No one should trade. I don't want people. I don't want this book to be dogmatic. Okay, this is what you have to do. You have to use the Anchored VWAP and nothing else. I use it as one of my primary tools, not my only tool. And I think that anyone who adds it to their arsenal in technical analysis, I've never met anyone that I've introduced this to who said, man, that just doesn't work. I'm not going to use it. Instead, most people say, that blows my mind how often it's the exact turn point. Brian, thanks for teaching this to me. So I say to them, tell everyone, go buy the book. It's on Amazon and it's on Google Play Books if you want an ebook. It's in 60 countries.
Yeah, I mean, I think one of the most powerful points you make in the book is just, you've observed this so many times and it works. I mean, it's amazing how many times this little line acts as support or resistance so many times. And if you observe it like I have too, it's too many times to know that it's more than just coincidence, right?
And that's the joke I always make on Twitter is, it must be a coincidence that it turned exactly at that spot. I was on Fox a week ago today, I think, and I, said to Charles Payne, right here, right now, it's touching the Anchored VWAP off the all-time high at a 38.2% retracement. I don't trust this market. Here we are a week later. That it never ticked above that level. I'm not calling it top there certainly, but it was a place to say, where has it come from? And use some common sense. And when it comes to, people are always chasing stocks, looking to make money on what's already moved rather than trying to anticipate the move. and then sell when that euphoria comes. And rather than being a FOMO chaser, you start selling into that FOMO. And it's such a good feeling to say, everyone's enthusiastic about this. Twitter's lighting up. That's my signal to sell partial of this thing. It's not time to be a buyer.
Right. I mean, this week, probably one of the most important charts out there right now is the dollar index. And you kind of had that little tongue-in-cheek joke there where you said, yeah, I'm sure it's just a coincidence that the dollar found support at that VWAP anchored to the 2021 low there. It saw a decent rebound.
Yeah, and you know what? Bitcoin, is for the last couple of weeks been hanging around this anchored VWAP from, I think it was the March 21 high, and it's finally backing away from there. It looks like it's most likely headed for the year-to-date anchored volume-weighted average price at about 21,000 even, and that becomes, even like you just said, if as you were speaking of myself in the book, saying, it still blows my mind that these often turn into the exact turn points. I still don't use them as an action point. That's the difference. I don't trust them because I've seen enough of them fail as well. I know that nothing's 100% in the market, but it's a level of interest. It tells me now we're at this level, this year-to-date anchored volume-weighted average price. Now it's time to look at a shorter-term time frame and look for evidence that the buyers are defending this level and that it's possible that it could turn. So if that's the case, now I'm in anticipatory mode and I want to start planning my trade, my if then, coming up with my risk reward. Okay, if it bounces off 21 and it breaks past that, 5-day moving average at 21,250, I want to be a buyer there with a stop at 20,850, which was $50 below that prior, the most recent relevant higher low. So it's about using them as reference levels that's based on truth of supply and demand to gain our edge.
Yeah, that's a phrase I've kind of stolen from you over the years. Is it's a level of interest. I think terms like support and resistance, they kind of it's easy to take those for granted and say, oh yes, this is going to be support. They're levels of interest. Nobody really knows how price is going to behave there. But anyways, I think we got to wrap it up now. To our viewers, definitely go check out the book. It's a great resource for both beginners and professionals. Tons of actionable advice in there. And it's already selling out pretty quick. Am I wrong?
Yeah, I've got, it's a whole different story. I don't want to go down that road. But there's been an inventory problem at Amazon, and it's been very well received. So pretty much every day it sells out. It hit 266 on the top sellers of Amazon overall. So, people are getting, good response to it. And I think that it will help anyone become better at, understanding market structure and, timing and ultimately making more money, which is what this is all about.
Yeah, I think it's going to be a classic. But Brian, thank you again for joining us and hope you have a great weekend. Thank you guys for watching. If you enjoyed the show, be sure to click like and subscribe, and we'll see you again next week. Thanks.